Take one hypothetical $2,500 paycheck and freeze the clock the second it reaches checking. This is not an average paycheck, and the 48-hour window is not a rule for every household. We're using one simple example to expose something your bank balance does not show clearly: when each dollar became committed. At 9 in the morning, the deposit lands. Your app shows $2,500. For about 3 seconds, that number can feel like relief. But the first mistake is starting the story at the bank account. The paycheck started changing before it reached checking. For employees subject to normal payroll withholding, employers generally withhold applicable federal income tax and employment taxes from wages. Other payroll deductions may also apply, depending on the worker and benefits. So gross pay and the deposit that appears in checking are not the same number. That sounds obvious.
But it matters, because many people mentally treat the deposit as the beginning of the money story. It is not. It is only the moment the remaining cash becomes visible. Now, unfreeze the clock. Our hypothetical $2,500 is sitting in checking.
Before we buy coffee, order food, or touch a shopping app, we need to separate two kinds of money: committed money and flexible money. Committed money is the label we are using in this video for cash that already has a known destination under your plan or an existing obligation.
Rent, insurance, a scheduled debt payment, a recurring bill, an automatic payment you already authorized. Flexible money is what remains available for new decisions after those known commitments are accounted for. These are teaching labels, not official banking definitions. And here is where the account balance can become psychologically noisy.
The banking app may still show $2,500, even when you already know that $1,500 of those dollars has somewhere to go. The app is showing cash in the account. It is not reading your calendar, your mental budget, and every decision you made 3 weeks ago as one clean number called safe to spend. So, let us mark the first commitment. Imagine $800 is reserved for housing. The bank balance still says $2,500, but under our framework, flexible cash just dropped to $1,700. Now imagine $300 is reserved for a car payment. The visible balance may not have changed yet. Flexible cash drops to $1,400. $200 for insurance and utilities that are expected soon. Flexible cash becomes $1,200. Then recurring payments enter the picture. The Consumer Financial Protection Bureau explains that automatic payments can be set up by authorizing a company to electronically withdraw money from a checking account or debit card on a recurring basis. The important word is authorized.
These payments did not appear from nowhere on payday. The decision may have been made months earlier. A streaming plan, a gym membership, a software subscription, a phone bill, a minimum debt payment. Individually, each one can look manageable, but payday compresses the consequences of old decisions into one account.
Suppose another $300 is already assigned to recurring charges and scheduled payments. Now our hypothetical flexible cash is $900. Look at the screen. The checking account can still show a number much higher than $900 until transactions post. That gap is the tension.
Visible cash is not always the same as uncommitted cash under this framework, and this is why simply checking your balance can give you incomplete information. You're looking at location. Where is the money right now? But the more useful question is assignment. Which dollars already have a destination?
Now, the clock moves forward. An $18 lunch, a $64 online order, and $112 at the grocery store enter the same account. None of those purchases is automatically irresponsible. The conflict is simpler. New spending is competing with money that already has a destination, while the bank balance still mixes both groups together.
The app shows location. It shows where the cash sits right now. But our paycheck autopsy needs a different question. When did each dollar stop being flexible? Because the moment you answer that, the 48-hour story changes. The paycheck may not be disappearing after payday.
Part of it may have stopped being available for new decisions before payday ever arrived. And that is where the real money trail begins. Start one step earlier. Open the calendar before you open the banking app. Take every payment you expect before the next paycheck and place it on the timeline. The point is visibility. In our example, housing was assigned $800. The car payment was assigned $300. Insurance and utilities were assigned $200. Recurring and scheduled payments were assigned another $300. That is $1,600 with known destinations. The checking account received $2,500. So before the lunch, the online order, and the grocery trip, our framework shows $900 of flexible cash. Now subtract those 3 new purchases: $18, $64, $112. Flexible cash falls from $900 to $706.
But depending on when transactions settle, the visible account balance may still show a larger number for part of this timeline. That is the gap you are trying to expose. Do not ask only, "What is my balance?" Ask, "What is my balance after known commitments?" For this video, we can express the idea with one simple line. Visible cash minus already committed cash equals flexible cash. Flexible cash is our teaching label. Your bank does not calculate this number for you, and this is not an accounting standard. It is a way to make the money trail visible. Now move to hour 24. A scheduled payment settles. Then another recurring payment posts. The bank balance finally begins showing some commitments we marked earlier, and this creates the feeling that payday money suddenly vanished. But nothing in our example vanished. Some money was withheld before the deposit. Some was assigned to known obligations. Some left through recurring or schedule payments. Some was used for new spending. 4 different events can feel like one emotional experience. I got paid, and now the money is gone. That sentence hides the timeline, and the timeline is where the useful information lives. Now move to hour 48. Instead of staring at one smaller balance, rewind every dollar. Which dollars never reached checking because of payroll withholding or deductions? Which dollars reached checking but already had known destinations? Which dollars were used for new decisions after payday? And which dollars remain flexible now? That is the paycheck autopsy. The purpose is not to shame every purchase. It is to stop asking one number to answer 4 different questions. Your account balance can show how much cash is currently reflected in the account. It cannot decide which portion you mentally reserved for rent. It cannot know that you plan to pay insurance next Tuesday unless a transaction or scheduled banking feature reflects it. And it cannot tell you whether a new purchase fits the priorities you chose. That part requires your own system. The stakes become clearer when cash buffers are thin. In the Federal Reserve Survey covering 2025, 63% of adults said they would cover a hypothetical $400 emergency expense using cash or its equivalent. That survey does not measure our 48-hour paycheck example. But it shows why understanding available cash and financial buffers matters. A small assignment gap can become a bigger problem when an unexpected expense arrives. So here is the practical experiment. For your next paycheck, begin with time. Write down the deposit. Then list every known cash commitment expected before the following paycheck. Separate those commitments from money still available for new decisions. Then watch what changes during the first 48 hours. You may discover that spending after payday is the main pressure. You may discover that old commitments consume more than you expected. You may discover that bill timing creates a cash flow problem even when monthly income looks adequate on paper. Or you may discover that the system is already working well. The point is not to force one answer. The point is to find your answer with a visible money trail. Because the better question is no longer, where did my paycheck go? The better question is, when did each dollar get assigned? Once you can see that moment, payday becomes easier to read. The bank balance is still useful, but now it is only one number in the story. You also know the number that matters for your next decision. What remains flexible after the commitments you already know about? If invisible money systems are the part of personal finance you want exposed, subscribe to the Wealthy Challenge. We follow the money trail, not the shame. Your next paycheck is already a case study. Freeze the clock. Mark the commitments. Then see what the first 48 hours actually reveal.